makers and market movers. This is The Pulse.
Good morning. Welcome to The Pulse. I'm Tom McKenzie in London. Happy Friday, everyone. The EU has agreed then to lend Ukraine 90 billion euros of its own funds after failing to reach a breakthrough on using frozen Russian assets. Following marathon talks in Brussels, French President Emmanuel Macron said Europe will need to find a way to directly engage with Russia. Let's get more with Bloomberg's Oliver Crook, our chief Europe correspondent. He's on the ground for us in Brussels, following all of this, of course, for us. Ollie, tell us about the nature of the loan and the failure to really use these Russian assets.
Yeah, well, Tom, depending on how you see it, you can see this as a failure and a success. And I think that that is exactly the line that the Europeans wanted to tread, and basically saying that, on the one hand, yes, the Russian assets are still being held. And technically speaking, in the longer term, they're backing this loan. But they have sort of capitulated from the original plan, because that 90 billion euro loan to the Ukrainians, which will be at zero interest, which will fund Ukraine 2/3 of the way for the next 2 years, will be backed by the European budget, by joint debt, not primarily by the Russian assets. Now, what the Europeans have said in the way to sort of fudge this is that in the longer term, the Ukrainians will only have to repay this loan if the Russians pay reparations to Ukraine. If the Russians do not do that, then the Russian assets are back in play. So this sort of solves the problem in some respects for the Europeans. The first thing it does is it does bring financing to Ukraine, which we know is very desperate for that money, that they run out of money in the first quarter of next year. So it solves that problem. This circumvents some of the issues that Belgium and some of the other member states of Europe have had, such as Hungary, Slovakia, and the Czech Republic. Those three, for example, are carved out from sort of having any backing to that loan. They're exempt from having to back it. And the third thing that the European member states can say, sort of truthfully, is that this risk does not sit on their balance sheet. But that's not quite the full story. So it's a little bit of a complicated process. Depending on how you look at it, this is an intensely elegant solution to a very complex problem, or it's a really complicated fudge to something that they have just decided not to make a decision on quite yet.
So there are still question marks then, Ollie. I mean, what happens? We have this 2-year time frame then in terms of the loan, tying Ukraine over for that period of time. What are you watching for next? When does that loan get dispersed?
Yeah, well, so they're going to need to disperse that loan very quickly, because as the Ukrainians have told us, they basically run out of money in the first quarter. And when I spoke to Zelensky basically a month ago, he said that this money is a matter of survival for the Ukrainians, their ability to withstand the pummeling from the Russians that we've had over the last certainly the last couple of months, more intensifying, but over the last few years. But what I think is interesting is how this is going to play into the peace negotiations. We expect those peace negotiations to resume over the weekend between the U.S. and the Russian delegation after that 20-point plan got a sort of makeover by the Europeans and the Ukrainians. What we're looking for now is the reaction to the Russians to this European plan. We've had just a sort of glimmer of that from Kirill Dmitriev, who's sort of the lead negotiator from the Russian side on the peace negotiations, also head of the Sovereign Wealth Fund. He came out on Twitter when we started to see that the Europeans were not going to actually seize the assets, but we're going to go with the loan. He said, if true, shelving the EU's originally proposed illegal scheme to tap Russian foreign reserves to fund Ukraine is a major win for law and common sense, and for the voices of reason in Europe that protect the EU, the euro, and Euroclear. So if we have any sort of reaction from the Russians, and if that is anything to go by, a sort of positive reaction for the Russians, on the one hand, this leaves the sort of path open for conversation, for dialogue, for the peace proposal, while still leaving the tension in the air, because those Russian assets are still frozen and the Europeans can still move on them.
OK, Oliver Crook, Bloomberg's chief Europe correspondent, with the details of that loan, the implications for those peace negotiations, of course. Ollie, thank you. Let's get to macroeconomics now and monetary policy, because, of course, the Bank of Japan has raised interest rates, and the governor says the benchmark interest rate remains some distance from the lower end of the neutral rate range. Earlier today, the central bank, of course, raised those rates then to the highest level since 1995.
It is difficult to determine the neutral rate in advance, and it is necessary to consider it within a fairly wide range. On that basis, we believe it is appropriate to continue monitoring how changes in short-term interest rates affect the economy and prices, while exploring the level of the neutral rate and adjusting the degree of easing accordingly.
OK, let's bring in Paul Jackson now, our Japan government and economics editor in Tokyo. Paul, just make sense of this for us then. The rates increase as almost fully expected to 0.75%. Yields are up, but the Japanese yen is down about 0.9%. And the Bank of Japan is saying they still have scope to increase rates further from here. Just make sense of that picture for us.
Yeah, well, I think it was so telegraphed in the rate hike that it was all about the forecast, the outlook for where rates might go. And in Japan, Japanese media has been fixated on this neutral interest rate concept, thinking, well, Governor Ueda is an academic, he likes the textbooks. Maybe this prescription of finding the neutral rate, which neither stimulates nor restricts the economy, that's kind of the end game for your rate hike cycle. So he referred to it in Parliament recently, and so there was a lot of attention on, is he going to use this neutral interest rate estimate as a way of giving guidance on where rates might go in the future. And I think that the takeaway from what is repeatedly said is no, I don't want to use a textbook. That's a very interesting theoretical concept. Of course, we do need to understand that. But in the real world, it's all about pragmatism. You go up a little bit, you see how the economy responds. If it's still growing, it means you can go up again. And that's the view that is repeated today. And clearly, for the traders out there in the markets, that wasn't enough.
OK, so that's the market reaction, Paul. What about economists? How has the view been adjusted on the back of today, what we've heard at the press conference, in terms of how to think about future hikes, if indeed they do come through? I read one piece of analysis saying maybe it's going to be at a 6-month cadence.
Yeah, I mean, I think that is the overall consensus amongst economists and market participants, really, is, once every 6 months he hikes. That's maybe as fast as he can go. Could get slowed down a little bit. We've got this expansionist Prime Minister, Sanai Takaichi, in power. She might get cold feet or want to disrupt the rate hikes if the economy tanks. And this is something that the Bank of Japan has done in the past by going too fast with rate hikes. So that's certainly got to be on his radar as he goes forward. But I think, he's repeated his message over and over again. If the economy develops in the way we expect, we are going to continue to raise rates. So really, there was enough there to suggest that rates will continue to go up, even though the market moves suggested otherwise.
Paul, thank you very much indeed. Always excellent analysis in terms of the BOJ and how to think about things and the path forward. Currently, the Japanese yen down 0.9% at 156, closing in on 157. Paul Jackson in Tokyo, thank you. Now, for more on the BOJ and wider markets, we're joined by Michael Metcalfe, Head of Macro Strategy at State Street Global Markets. Michael, always great to get your insights as well. So let's start on the BOJ then. Are you convinced that this is a BOJ that has the space to increase rates further from here? And what are you thinking about in terms of the so-called neutral rate for the BOJ?
Well, I think that question that you started with, Paul, about why markets have reacted the way they did, I'm pleased you asked him that, not me, because I think Ueda did everything that he should have done in terms of signalling that hikes are coming. He's never going to be direct enough to say, I think the neutral rate is at 2 and that's where we should go, because he's not going to pre-commit to that. Nevertheless, I think this was a change. If you think about where the market was 2-3 months ago, it was the idea that the change in government would mean that the BOJ would have to be more dovish. And that, I think, clearly isn't going to be the case. I think that the policy settings in Japan, there's going to be stimulative fiscal policy, which means that rates do need to go a bit faster, which means 1.5 and above. And that isn't yet fully priced in the market. So I think despite the market reaction today, I do think we're going to get tightening in Japan, and I do think that will ultimately lead to a stronger yen.
And you think rates ultimately 1.5 and above?
Yeah.
And in what kind of time frame?
Well, so I think to Paul's point, the BOJ has been and continues to be quite cautious. I think if they have the inflation to justify it, which they currently do, it's not impossible that they could start to go in quarterly increments. And maybe that would... The market reaction today, I think, will be disappointing for them. And they'll be surprised that the market has reacted that it's a dovish hike, which I think his commentary suggests that it isn't. But look, I think sometimes we overread intraday market reactions, which in thin markets like today, it could just be that the market's quite thin and there's been a few flows that have gone the other way.
That's really fair.
So we shouldn't extrapolate, I guess, is what I'm saying.
But what you do see is a picture of narrowing rate divergence between the Fed then and the BOJ. And so my question then is, what does that do to capital flows? I mean, we're seeing a little bit, some modest selling in European sovereign debt and treasuries today, and some are linking that to the rate increase by the BOJ. What does that do to capital flows? I mean, how much is that a risk for the sovereign debt of the Eurozone and the US? Everywhere.
Yeah, I mean, and look,
how challenging would that be?
So I think in kind of all the year ahead outlooks, there's always this question. So everyone always favours Japan. They're always waiting for Japanese rates to go up, and then also the impact of that of Japanese investors to bring money home.
Yeah.
And look, I think what we can say is that so far the experience of 2025 is they have not done that yet. But it remains a risk going forward that they will. I mean, look, rate differentials are still favouring, to some extent, Japanese investors to put some money abroad. But it would be surprising, given where long-term Japanese yields are now, that you don't get some repatriation and we don't eventually get this correction in what is still, by far and away, the most dislocated market right now is the Japanese yen and its valuation. And so at some point we're going to get a correction in that.
Let me get to the UK then. So inflation in the UK is down, growth is down, unemployment is up. Is the BOE behind the curve?
Well, not yet. I think you can understand why the BOE has been cautious simply because of where wages have been, and inflation has been sticky. But eventually you'd expect the weakness in the economy and the weakness in the labour market in particular to drag both of those things down. So, I actually think the market is a little bit underpriced for UK rate cuts right now. And we could get more rate cuts next year than the market currently prices.
Two? More than two?
Yeah, 2 or 3, or maybe even 3 or 4 actually, because I think that the weakness of labour market demand in the UK is very clear. The UK is a standout on things like job postings and metrics like that. That the labour market here is much weaker. So I think eventually you will get.
We could be below 3% then by the end of next year. On the beat, if we get 4, we're at 3.
Yeah, I mean, I don't think it would be our central scenario, but there is a risk that if the economy weakens further, then clearly that's the risks are all skewed to that side, I think.
You've talked about the need to look for hedges in 2026. In 2026, investors need to be ready for a range of outcomes and be ready to hedge accordingly. What are your favourite hedges?
Well, so I think, look, our concern right now is we go into 26 with investors' allocation to equities very stretched relative to bonds. And when we look at what typically happens next, you either have very good scenarios, which is the kind of the pre-bubble stuff, or very bad scenarios, which is obviously the bubble bursting. And so, I think it's, going into alternates, and just reducing your risk on beta, because I think that's just the danger is that, and look, it's the same danger we went into 25 with, is that investors are very overweight risky assets right now, and we're going into 26 with the same level of holdings.
It's on AI. Before we let you go, is Oracle now the canary in the coal mine for whether or not the AI momentum can continue? What are you watching for in terms of what could be a trigger point either down or for further gains to reassure the markets on AI?
So I think the lesson from this year, and look, every major earnings announcement has been a potential trigger point, and I think almost every time this year they've actually been a validation point rather than anything else. So we capture the fact that investors are very overweight equities. Obviously, their biggest overweight is in tech. And so you can understand that investors lighten ahead of all the big major earnings announcements.
Yes.
And then every time they rebuild afterwards. And so, I do think actually the story is relatively straightforward. It is earnings driven.
Okay.
And right now the earnings and generally the news flow has been pretty positive. So it kind of justifies the position and it's hard to go against it. And that's the challenge.
Fantastic to get your insights as we close out and get towards the end of 2025 and look ahead to next year. Of course, Michael Metcalfe, Head of Macro Strategy at State Street Global Markets. Michael, thank you. Coming up, money has been pouring into data centres amid that AI boom. We've just discussed it with Michael. We'll discuss what it means for the real estate outlook with Chris Brett, European Head of Capital Markets at CBRE. That is next. This is Bloomberg. The conversations that matter, the insights you need. This is The Pulse. I'm Tom Mackenzie in London. Now, the global property market is showing tentative signs of a recovery as easing interest rates bring back some of the conditions that powered the previous rally. This time, there's also huge demand, of course, for infrastructure linked to data centres and the AI boom, although some investors worry that the level of capex spent could be getting out of hand. One firm making a shift into operations tied to digital and power infrastructure is the commercial real estate company CBRE. Joining me now is Chris Brett, the firm's European head of capital markets. Chris, before I get your take on AI and the spending boom there, just looking back on 2025, how has the year shaped up? What are some of the key themes that have come through for your space and your sector in terms of transactions and activity and where the regional impulse has been?
Sure. Good morning, Tom. 2025 had a little bit of a slow start, but as we sit here today at the end of Q3, volumes are up 8% year on year across Europe, which is clearly a good sign. We have been buoyed by the amount of debt capital that has been available in the markets across all sectors. And as we said at the beginning of the year, living and logistics would be the two sectors which captured the most capital around the region. That has been the case, but I think the surprise of the year, Tom, has been the interest and the transactional activity in retail, which is a really good sign for that sector, which has clearly had a very tough time during and post-COVID.
What do you think is underpinning that interest in retail, Chris?
Well, I think that very simplistically, it can't be worse than being closed, right? Like it was in COVID. And actually, what COVID did for the retail sector was it really secured the balance sheet of a shopping centre, a retail park or a high street and those retail tenants. And that has given people the confidence that actually when they're buying a retail asset, the income that's underpinning those assets is exceptionally strong and perhaps stronger than it was pre-COVID. At the same time, the cap rate in the sector has moved out considerably, and just versus other sectors, I think retail therefore looks like a pretty attractive buy. Hence, we've seen that spike in activity during 2025. And Tom, we expect that to continue in 2026.
OK, so the interest in retail continues in 2026. What about the office space? There have been some anecdotes, Chris, around the office space starting to tighten in London, some big name projects coming on board and some big tech companies looking for additional space and additional real estate and to be able to expand their headcount here in London, just as one example. Is office coming back, and does that momentum continue in 2026 if that momentum is there?
I think there's no doubt about it. Office is definitely coming back. And it's had a much better 2025. And we can feel that momentum growing in the sector. It's really been very underpinned by the strong leasing demand that you just referred to, actually, with companies looking to take more space. And we've seen the best buildings attract top-class tenants. And we've seen a very strong rental growth story. And this is evident across all parts of the market in both London and other major cities around the world. The investor demand has been a little bit slower than the occupier demand, but we're seeing that catch up now, Tom. And again, we see a lot of capital that is now focused on offices for the rest of this year and certainly into 2026.
We were just talking about the lower rate regime that we're starting to see. The Bank of England, of course, cutting rates. The Fed looking to cut further. Potentially, that's the market expectation next year. How supportive is that lower rate regime for the space that you operate in? And how much of a catalyst for next year?
Well, it makes a huge difference, right? I mean, and when you look at volume activity this year, volumes are slightly down on the UK, but they're much higher and up on 2024 across Europe. And you know better than I do, ECB rates have been at 2%, whereas UK's been at 4% up until yesterday. And so that differential in the cost of borrowing has clearly had an impact on investor demand and capital that's gone into our sector. But the availability of debt from mainstream banks, from alternative lenders, is clearly there, which is giving the sector a real confidence across all the different verticals within real estate that actually there is enough debt capital to go into 2026 with real confidence. What I would say, though, and we hope we try and learn lessons from previous cycles, that the debt capital and the loan to value ratios are much more in line with prudent investing versus when we went into the 2008 GFC, where clearly debt and leverage ratios got a little bit out of whack.
Chris, when we think about debt ratios and leverage ratios, we can think about AI and the building boom there. So I guess my question is, how is that reshaping your sector? And are there any red flags for you in terms of what is being built out, what is being committed, whether it's the lease agreements or anything else within what you've seen there that is causing any concern?
I think the biggest red flag, and I remember talking about this on your show earlier this year, is really not the demand from the companies and not the availability to actually go and build, but it's the planning regime, which is quite tough. And it's really around the power and the availability of power wherever we look in any geography. Can it sustain the building activity that we need for data centres to grow? So I don't think there's certainly as we see it today, there's not a red flag around data centres per se. What we are, though, seeing with data centres is, given the scale and given the amount of capital available and needed, we are seeing this merger of infrastructure capital with real estate capital coming together. And I think that is a really interesting dynamic that we're going to see play out even more during 2026 and beyond, Tom.
That's really interesting. OK, so we look for that merger between infrastructure and real estate capital in 2026, and if that continues. Chris Brett, really important and interesting insights into the real estate space. Thank you, Head of EMEA Capital Markets at CBRE. Coming up, Swedish tech darling Lovable closing a fresh round of funding, tripling the value of the vibe coding startup to $6.6 billion. We're going to be joined by Anton, Osika, Lovable's CEO and co-founder, for an exclusive conversation. That is next. This is Bloomberg. Good morning. Welcome to The Pulse. I'm Tom Mackenzie in London. Happy Friday. These are your top stories. The EU greenlights a €90 billion loan to Ukraine after plans to use frozen Russian assets fails despite marathon talks in Brussels. Governor Ueda strikes a cautious tone after the Bank of Japan hikes interest rates to a 30-year high. Plus, Nike tumbles as the sportswear giant struggles to get back on track in China. Pre-market, you can see that stock called lower by close to 10%. Now, the Governor of the Bank of England has warned that the pace of interest rate cuts will slow as the BOE reaches the end of its cutting cycle. Andrew Bailey was speaking after the central bank voted 5-4 to cut rates by 25 points to a near 3-year low.
Now that we're on a path where we'll probably be around this level for a few months, but we think that come the spring, April, May time, we should see another quite sharp drop and take us, I hope, to around target. So we're going to come back to target sooner than we thought. So that's encouraging. All of this is very encouraging. And for me, certainly, it was a strong basis to cut today. It's the 6th cut we've made. Now, looking forwards, I do think we'll continue to have something of a gradual downward path.
Well, for more on the key central bank action we've seen over the past 2 weeks, let's bring in Vania Stavrakeva, Assistant Professor of Economics at the London Business School. Vania, great to have you in the studio. Thanks for coming in. What is your kind of takeaway from the central bank action that we've had so far this week? So the BOJ hiking as expected, the BOE cutting as expected, the ECB on hold as expected, and yet you lift the hood and there's significant divergence on views and on the path forward for all of these central banks.
So thank you so much for having me. Indeed, central banks are again front and center in the news for very good reason, and there is significant heterogeneity. So let me start maybe with Bank of England, and there are some parallels that I'm going to draw with the Federal Reserve. One of the main problems that Bank of England is facing is, of course, inflation is still elevated, the unemployment rate is picking up, and there are a lot of fiscal forces that are not helping the central bank. What do I mean by this? We recently had significant increase in taxes that are actually propelling wage growth due to higher minimum wages, higher national insurance contributions. So that is not helping tame down the inflation. On the other hand, the unemployment rate is increasing as a result of those fiscal forces as well. Another big problem, both for Bank of England and the US, is significant divergence in terms of view of what is the long-term natural rate. So what are we converging to? So when we have a discussion, is it going to be another 1 or 2 cuts? We need to know what is the consensus. Now,
here we're talking about the rate that is neither stimulative nor tightening.
Exactly. So if you look at an interesting report that the Federal Reserve publishes, which is the summary of economic projections, they tell you all the different FOMC committee members, where do they stand in their expectations of the long-run natural rate. So usually a very important number there is this kind of centrality tendency measure. So you remove the top 3 outliers, the bottom 3 outliers, and usually we find that spread is very narrow, right? It's only 2-3 basis points. At the moment, we are talking about a range in the US between 2.8 and 3.5. So how do we know
2.8 and 3.5?
Exactly. So even in the long run, there is massive divergence, even once we remove these outliers. So we're talking only about the middle 6 members of the committee of where we're going towards. So what does this mean for asset prices, right? So asset prices are forward-looking variables. So they're function of revisions and expectations over the whole path of policy rate. So the moment you start to have shocks driving the long-run natural rate, meaning markets don't know what we are converging towards, you're going to have massive market volatility. And this type of shocks are way more important than are we cutting next quarter by 0.25, because they're changing the whole trajectory of expectations going forward.
Okay, let me get to the volatility piece is really interesting. Before we get there then, what is the reason for this significant uncertainty on the path forward?
Perfect, that's a great question. It's supply shocks, and in this case AI. AI is another supply shock, right? We don't know what this is going to do to the labor market. There'll be massive heterogeneity across sectors. A lot of discussion centers around implementation, right, and adoption of AI. But adoption of AI is going to be very heterogeneous. It's going to have very different impacts across countries and within sectors across countries. So we don't know what is the new real, long-run real rate, right? So this is a standard productivity shock, which is a supply shock. So supply shocks generate this kind of divergence in views because we don't know whether in the long run the real growth rate is going to be 2.8 or 3.5, how important is going to be AI for long-run growth, and then on top of that there'll be massive heterogeneity across sectors.
Do you expect to get a start to that answer next year?
No, there'll be no answer directly, but I do expect that there'll be way more discussions on that. And this is going to show up in the numbers through impact on employment across different sectors, through impact on productivity. I do expect that we're going to get an interesting dynamic where you might find good profits, which we have been seeing in the US in certain sectors that are linked to tech, bad performance in others. It will be a function of the adoption of AI and other factors, but moreover, the labor market is where we're going to see much more bifurcation, right? We see, for example, in the UK and in the US, where certain jobs still demand higher wages and high inflation in terms of wages if they're complementary to AI, but to the extent that some jobs are going to be substitutes to AI, those jobs are going to disappear, and the wages in those sectors are going to become lower. So central banks will have to deal with this heterogeneity, which is going to be even bigger than what we've seen so far as AI starts to get adopted across different sectors and countries.
That's really interesting. And so this increases volatility, and,
yes.
and investors should be prepared for that in the years ahead as a result of what you've just described. Do the central bank frameworks need to be reworked in light of this uncertainty and this fundamental change?
Absolutely. It creates a massive problem for central banks because historically central banks hit it easy. What do I mean by this? The correlation between the unemployment rate, output gap, real GDP growth was very strong. And they almost use these different variables as substitutes. This will no longer be the case. You can have very fast real GDP growth and the labor market doing very poorly, etc., and then they will have to prioritize. Clearly, the Fed has a objective function which is linked to the employment rate, but having said that, even there'll be massive heterogeneity. And we are seeing this in the UK as well. Fiscal policies are not helping, of course, in the UK in terms of creating high unemployment among lower income and younger people, etc. But more divergence, much harder objectives in terms of how we define them and how we measure things. So we need central bankers that are equipped to tackle those problems.
Really interesting, fascinating. Vania, thank you very much indeed for bringing that insight to us this Friday morning. Vania Stavrakeva, Assistant Professor of Economics at the London Business School. We're going to stay on AI and do a deeper dive into a particular sector of that space, because Swedish AI startup Lovable has just closed a $330 million Series B funding round, valuing the company at $6.6 billion. That is treble the valuation from the company's previous round back in July. Lovable specializes in so-called vibe coding. Its AI-powered platform enables users to build applications without writing code. The latest fundraising round includes the VC arms of both Alphabet and Nvidia. Joining us now exclusively is Anton, Osika, CEO and co-founder of Lovable. Anton, fantastic to get your time. Congratulations on the raise. It is significant. It's a chunky amount of money. How are you going to be putting it to play, Anton?
Great to see you again, Tom. And we're super excited about this new era where anyone can build. And what we're going to do is to continue to support both founders that have been starting new companies from scratch using our product, and the really large companies out there that we're seeing a lot of success using Lovable. Microsoft, Uber, and a large part of Fortune 500 companies. And what we're building out is more integrations to everything else that you're running your company and collaborating with. So other tools, where many of these tools are investing in this round. So we're seeing support from HubSpot, Databricks, as you mentioned, Nvidia, and many more. And then on top of these integrations, we have been differentiating in making vibe coding secure since the early this year, and we're going to continue to invest in being the most secure place to build with AI.
That's really interesting, and you're bringing me to a question around the enterprise push for you and the team, Anton. How significant do the revenue streams from enterprise, and you've already, as you've mentioned, got companies like Klarna, Uber, Zendesk already adopting your services and your platform and your capabilities. How important does enterprise become for you versus the individual, and how are you ensuring that security component for them?
So the shifts we're fundamentally seeing is that building things has been the biggest blocker for businesses, and many individuals are now discovering how much you can get done when you build software without being bottlenecked by not being able to code. So the individuals who are the ones who have discovered the power of Lovable, and they are taking it into their work, into the enterprise. And at the same time, we're seeing people who discover Lovable from their colleagues and bringing it out into their small businesses, to their personal use cases. So we're focusing on making the enterprise adoption much easier over the coming months. It's, as you say, there are all of these companies that are now even listing Lovable in job requirements as they're hiring more people. At the same time, we're supporting both of these groups.
So, Anton, on the security part for enterprise, how do you make sure that AI-developed apps are both secure and auditable?
So I love that you bring up auditable. So one part is, of course, that the software that's being created with Lovable does not have security vulnerabilities. And that's something that has been traditionally very difficult to guarantee, because us humans, it takes a long time for us to verify that something is secure. What we're starting to see is that AI can much faster validate if code is secure. Currently, we don't have a 100% guarantee that something does not have a security vulnerability. It's in the same way that your iPhone might have a security vulnerability right now. But we're seeing that AI is going to be able to do this better than humans. And then the other part is the data and being able to audit who has access to which data. And that's something where we're pushing forward a new standard for how you give access to the AI and how you give access to AI agents, and how you give access to humans of which data in your enterprise, which is currently a huge pain point where configuring who has access to what is been a blocker for productivity in large companies, medium companies, even in the government.
Anton, I want to get you some growth stats from you. So you famously hit $100 million in annual recurring revenue, that milestone, within just 8 months. You doubled that 4 months later. What is annual recurring revenue looking like by the end of this year, and what's your target for next year?
So I'm looking forward to see what happens next year. But what I can say is that we've more than tripled the revenue since our last fundraise, and we're so far this year. Since we decided on taking the investments from this round, we beat our projections. And what we're focusing on now is just to make our customers as successful as possible, because we're doing this for the coming decades, as we think that we have an opportunity here to architect how do we humans build software. And that's going to be a very, very long-term effort. I think it's early days in everything that we're doing, and that's why we're so excited to partner with the current investors that are coming on.
Anton, let me push you on the ARR. Are you at 300 million right now or above that?
I'm looking forward to get way past 300. As I said, we announced 200 like a month ago, and we're way beyond that right now. Okay.
It's a competitive space, Anton, and one of your main competitors, Cursor, valued at almost $30 billion US dollars. What differentiates you from the competitors, and do you see consolidation in the space, or is this a winner-take-all?
So what we're hearing from everyone who loves Lovable and uses Lovable is that it just works. There's a lot of complexity under the hood that Lovable is reducing, while using that like simplification to ensure certain standards. For example, in terms of security and how the applications on Lovable are built to be secure and have AI included from the get-go. So there's this simplicity that we think is the future of how us humans will want to build software. And as for how this looks in the future, there are piles of gold in what value you can unlock for businesses and for individuals across the board. We are ensuring that we create an interface that can be used by everyone, by CEOs, CROs that are building their command centers in Lovable right now, as well as your mom and pop store that's creating a new website for this store.
Anton, what stops OpenAI and Anthropic replicating what you do?
So it's a very complex product that we're building, and that's something that we're seeing when people try Lovable, that all of this complexity is boiled down. Maybe there's some Scandinavian design taste that people talk about that makes people just keep coming back to Lovable and absolutely love the experience.
Okay. Anton, I'm going to try and fold two questions into one. One is, you get asked this all the time, but your view probably changes because the environment changes. Who are the losers and who are the winners when it comes to jobs as an impact of this? And how are you thinking about an IPO?
Okay, so the winners, I think, is what we're seeing since we launched Lovable about 1 year ago, is that there's a movement being spawned of that everyone can create. And this is extremely empowering, both to individuals in large companies and, for example, founders and educators for starting new companies and new economic opportunities. I think it's truly an example of AI being a democratizing force, where it was previously very difficult to collect a team that could create amazing software. Now, anyone, anywhere in the world can do that. I don't see, I see this like democratizing force as something where there will be more winners, and currently maybe some of the big winners are going to have a more competitive experience, which I think is good, very, very good for consumers. As for an IPO, it's not something we're looking at right now, but I'll make sure that we're doing whatever decision is best for our business and for our customers.
Anton, really appreciate your time. Thank you so much. Anton Osika, CEO and co-founder of Lovable, joining us exclusively from Stockholm. Coming up, gold hovering near record levels after softer than expected US inflation data. We're going to get the view from Amy Gower, metals and mining commodities strategist at Morgan Stanley. That is next. This is Bloomberg. Gold and silver hovering near record highs after slower than expected inflation in the US supported bets for more interest rate cuts from the Fed. We're joined now by Amy Gower, metals and mining commodity strategist at Morgan Stanley, and certainly interest rates, part of the thinking, of course, when you think about this space. Amy, good morning. Thanks for joining us in the studio. And you write, we are above consensus for almost all metals in 2026. What are your targets and why?
Yeah, so I think the metal story remains very positive as we look into 2026. And I think the key things we're thinking about is the ongoing expected rate cuts from the Fed, which are broadly supportive for commodities, which are non-yielding assets, also help many of the sectors we look at, things like construction, autos, making it cheaper to finance purchases, etc. And then we expect a bit more dollar weakness as well into the first half of next year. So that's, again, a nice tailwind for commodities. And then I'd say broadly, we've got quite good supply-demand balances, looking quite tight across many of the metals. So the ones we're most positive on, we have uranium, lithium, copper up there as well, aluminium. And then we think that the gold rally is not yet done either. So maybe slightly slower paces of gains than we've had this year, but more to go.
So I have to get you on gold. Do we get to 5,000 next year?
We have 4,800, so just shy of 5,000.
Yep.
But of course, we can get volatility around intraday moves. I think the key thing for gold next year is going to be we likely will see a continuation of exchange-traded funds buying large quantities of gold. We see their behaviour is very linked to what the Fed is doing.
Why are you more cautious on iron ore and zinc?
Yeah, so for iron ore, it's a combination of factors. So we think China will be probably buying less iron ore. So we've actually seen very strong iron ore imports this year from China, but that is starting to show up in elevated port inventories. They are declining their steel production, so they just won't need as much. And then there's also a large new iron ore mine coming on in Guinea. That's just done its first shipment, so we should be starting to fill those volumes in the market from next year. I would say, though, we don't think it's as bad as maybe some others in the market. We would say that the cost curve has shifted quite a lot higher over the last few years, so that will provide a floor. And then on zinc, we have mine supply coming through. We have China really producing a lot of refined zinc and then starting to export that. And that is also your construction linked metal, which is still a little soft.
Where are you seeing new sources of demand coming online next year?
Yeah, so the key one, I guess, is two actually. So one is the data center story linked to AI, and then the second is ESS, so stationary storage batteries. So these are particularly for copper, aluminium, and then lithium on the battery side as well are key beneficiaries here. So for AI, we think in copper alone, that could drive about 0.6 percentage points of our demand growth forecast. So it's driving about a third of total.
Just from AI?
Just from AI. That's based on our estimates for data center build out. Very copper intensive, and we're hearing, although copper is perhaps being replaced by fibre optic in some areas, it's still a very key part of the data centre. And then the stationary storage batteries. So this is really, as we put more renewables into the grid, as we have more pull from the data centres, things are getting more unstable. So we need that battery source to bridge the gap. So that's leading the way in China. But even in the US, some EV battery factories are now trying to repurpose themselves as stationary storage batteries.
We've seen a bit of impact in terms of tariffs and the hoarding, particularly of silver, platinum in the US, on expectations that maybe tariffs will be imposed on those metals. How much of an impact is that likely to have going forward? So the key, I guess, piece of legislation or thing we're waiting for there is the Section 232 on critical minerals that was launched back in April, covers silver, platinum, copper, many of the other metals as well. And we were supposed to hear on that in October. We haven't yet heard anything, perhaps because of the government shutdown. And that has driven metal across to the US. And actually, I'd say that has contributed to some of the silver price strength we've seen, because it's taken that metal out of London, moved it to the US. And then when exchange-traded funds have come to buy silver and wanted that physical offset, that metal's not been there in London. I think I would say it feels less likely that we will get tariffs on silver in the US. But I think that stockpiling has come through, and that is tightening markets. So if we don't get tariffs, do we see a headwind then for silver? Silver's outperformed gold by a long stretch this year. Does that continue? Does the tariff story, if there are no tariffs, does that derail the story for silver?
I think if we were to see metal moving back from the US to London, which is already starting to happen, that could ease up some of the pressures. And we have already seen that with lease rates in silver, which is the cost to borrow. They really surged in October. They've come off quite significantly as we've seen a bit of that metal moving back. So I think it reduces those kind of physical squeezes, but there's many other factors that can drive silver as well.
OK, really interesting. Amy, thank you very much indeed. Amy Gower, Morgan Stanley's metals and mining commodities strategist, with a view on how that space evolves in 2026. Amy, thank you. Switching focus now, because Nike is down around 10% in pre-market on a sales warning and problems in China. Bloomberg's business reporter Jennifer Creary joins me now with the details. What is going wrong with Nike then?
Really the pace of innovation under CEO Elliott Hill. And there are two persistent sore points here. So the first is Converse, the brand. Sales down 30%. Previously, the company really relied on sales of its iconic Chuck Taylor sneaker. But now that's really kind of lost consumer interest. The second sore point is Greater China, so sales are down 17%. And it's no surprise to any retailer in China. It's a tough consumer environment at the moment, but Nike has really been pummeled a lot harder than some of its rivals like Adidas, like Hoka. Selling off its excess inventory has proven particularly difficult at the moment in China. It's a very discount-heavy sportswear market. That's not a good sign for Nike because, no consumer wants to see products that are discounted and then being sold at full price. So really, there are a couple of green shoots, really. So Nike has been able to make progress in North America and also its running category, but it takes about 18 months to 2 years for new products to feed through. So it's going to take time for that turnaround to really take place. And shareholders clearly unhappy with the pace of that so far. Is there a need? Is Nike under pressure for a strategic change of direction given some of these challenges? Yeah, well, listen, CEO Elliott Hill says that, it won't be a straight line. We're acting decisively to accelerate those lagging areas. So really, he's saying, hold on for the time being. It's going to be up and down for Nike. It's worth remembering that they haven't issued full year guidance for a while now. So they're only issuing guidance for the following quarter. So really, we're going to see a lot of up and down for the company. It's the same diagnosis. So really, they need to boost in-store traffic. They need to innovate a lot quicker. They need to capture the zeitgeist, consumer interest. I think what's really interesting, there was one analyst comment that likened Nike's recovery to a marathon, not a sprint. They said that you can't expect the company to issue robust numbers when it's midway through its recovery. And I think that is very much the case for the company. OK, and we'll see if investors are patient as that analyst may be in terms of the marathon versus the sprint for Nike. Bloomberg Global business reporter Jennifer Creary with the update there, with Nike called lower by almost 10% pre-market. Thank you. Let's check in also pre-market on Oracle, on the news that TikTok will be setting up this US subsidiary and Oracle will be a key member of that US grouping that will take charge of TikTok US. We've still yet to have confirmation from Beijing that they are supporting this, but we know we're counting down to that renewed January deadline to get this agreement, of course, to ensure that TikTok is, at least to some extent, isolated from its ByteDance parent over in Beijing. And you can see Oracle's called higher by 6% on that. Cross asset, we're looking at S&P E-minis higher by 0.3%, a brighter picture than we've seen so far in Europe. 4.13 on the benchmark US 10-year. The Japanese yen continues to be under pressure. Look at that, down more than 1% at 157. And Brent still below $60 a barrel, softer by 0.3%. Up next, it's Bloomberg Brief. This is Bloomberg.